Hi everyone, welcome back to my channel. My name is Tess, and in this video, I'll be sharing with you 4 timeless investing concepts that I think have really withstood the test of time. These concepts have helped people like Warren Buffett and Charlie Munger to achieve their investing success, and I think these concepts will really help us to become better investors in the years to come. And be sure to watch till the end because I have a free gift for you. Let's dive right into the first concept, which is all intelligent investing is value investing. Regardless of what kind of investor you are, what kind of investments you make, you're trying to buy, an asset at a price that is much lower than what it's worth. So this is actually the fundamental concept of value investing. And Charlie Munger actually said this in an interview.
All intelligent investment is value investment. Because why would you want to buy something which wasn't worth as much as you were paying for it? And who wouldn't like buying something for less than it's worth? So some people, when they say value investor, they mean somebody that emphasizes working capital or something, meaning you should fish in that particular place. But I think that's all, I think it's a bad use of the language to think there's a difference between value investing and other good investing. All good investing is value investing.
So as Charlie Munger says, all intelligent and good investing is value investing. And now moving on to the second concept, Mr. Market is your servant, not your guide. So I'm sure many of us will know who Warren Buffett and who Charlie Munger is, but not many of us will actually be familiar with who this man in picture is. So he is actually Benjamin Graham, and Benjamin Graham is the founder and pioneer of value investing together with someone called David Dodds. So Benjamin Graham actually, came up with this analogy for the stock market as Mr. Market. So Mr. Market is this, imaginary character who will, knock on your door every day and ask you whether you want to buy or sell a stock. And just like us humans, we have different moods. Sometimes we feel happy, sometimes we feel sad. Mr. Market also has emotions. So whenever Mr. Market is very optimistic and very happy, he will knock on the door and offer you a very high price for the stock. And conversely, when Mr. Market is feeling very sad and very depressed, he will knock on your door and quote you a very low price for the stock. When Mr. Market's emotions are so terrible, it's almost like his emotions are swinging on a pendulum between extreme greed and extreme fear. These emotions are essentially the stock market because the stock market is made up of humans, and all of us humans as participants in the stock market, we have emotions as well. And the prices of a stock will also reflect the market expectations and humans' emotions, humans' feelings about the stock. Because of this very erratic, very bad temperament of Mr. Market, it can be very easy, for you to fall prey into his traps and, make very silly decisions such as like panic sell or, panic buy. So the key lesson here is that you should never let the stock market's emotions dictate what you should do in your investments. You shouldn't make decisions just because, of the price and just because of what the market thinks, because most of the time the crowd is usually wrong, and you should try to think in a way that is contrarian, that is different from the crowd as well. And next, margin of safety. So this concept is actually originally from engineering, and it can be applied to investing as well. And Warren Buffett actually calls this the cornerstone of stock investing. So what is margin of safety? You can think of it like an analogy of using a truck and a bridge. So imagine if you want to build a bridge that can carry trucks. So if, let's say, the truck weighs about 10 tons, you will want to design a bridge that can actually withstand 30 tons. You want to ensure that there's a sufficient buffer. So translating this into the world of investing, the idea is for you to calculate the intrinsic value of a company and only purchase this company when there's a significant discount to the intrinsic value that you have calculated. And the reason behind this is that you have to buffer for human error, you have to buffer for volatility and the risk that you are not aware of. Having a sufficient margin of safety of about 20-30% can help you, can prevent you from losing money. And why is losing money so bad, right? It's because imagine if you lose 50% in a year, you actually need to double your money in order to earn the entire amount back. Everyone can actually double your gains, quickly over a year or so. So that's why having a sufficient margin of safety is really important for an investor. Next concept is patience. So patience is a value that, it seems so easy on the surface, right? We are taught, to be very patient, to practice patience with others, with ourselves, and, with our friends when we're younger. But this quality of this virtue of being patient in the stock market is something that, not a lot of people actually have. And this can actually cost them, making them huge losses in the market if someone is very impatient. And if we take a look at this graph, we can see that 99% of Warren Buffett's wealth was earned after his 50th birthday. And this really shows us the power of compounding. It really takes a long while in order for your money to compound and your wealth to grow. And Warren Buffett also alluded to this in his recent Berkshire 2021 shareholder letter, whereby he said, "Please note particularly that we own stocks based upon our expectations about their long-term business performance, and not because we view them as vehicles for timely market moves. That point is crucial. Charlie and I are not stock pickers, we are business pickers." And so we can see that patience is really a virtue that pays off in the stock market, because it not only allows compounding to take effect, but also it's because of, you put yourself in the mindset of a CEO, of a business owner. Investing in stocks isn't just about clicking a button, but rather essentially you're owning a piece of the business. So imagine if you're a business owner, you will want the company to grow and prosper, and all this growth actually takes time. It's important to bear the long-term picture in mind, and having a bit of patience is actually one of the virtues that will pay off in the stock market. And those are the 4 timeless investing concepts that we've covered in this video. And if you'd like to learn more, I actually have 50 mental models for investors that I've compiled in this guide. And I'm happy to announce that I'll pick 8 random lucky subscribers who are subscribed to my channel from now till next week to receive a copy of this guide. So I actually revisited the works of Charlie Munger, Warren Buffett, and other famous super investors to create this guide of 50 mental models. And this guide contains a brief explanation of each mental models, coupled with my interpretation and my application to business and investing. So if you'd like to receive a copy, just subscribe to this channel and you might be a lucky winner. And with that, take care and stay curious. Bye!